In this video, you'll learn the 8 must-try short-term investments for quick returns. When you work hard to save money and have built up an emergency fund in a bank, you want to be careful about using that money. The last thing you want to do is put that money in an investment that could experience significant and unpredictable fluctuations. If you aim to save for something specific in the near future, like a down payment on a home, education, or a wedding, consider parking your money in a short-term investment. Why? Because these investments offer the potential for higher returns while ensuring your initial savings remain secure. Luckily, there are various options at your disposal, such as number 8, no penalty certificates of deposit. A no penalty certificate of deposit, also known as a CD, enables you to avoid fees banks usually charge if you withdraw funds before the CD matures. These are time deposits, where you commit to leaving the money in the account for a set period, ranging from weeks to several years, depending on your chosen maturity period. In return for securing your cash, the bank offers a higher interest rate. A no-penalty CD can be valuable for those wanting access to their money while earning interest. It becomes desirable during rising interest rates as you can withdraw without a fee and reinvest elsewhere for potentially higher returns. Since CDs are FDIC insured, your money remains safe. Short-term CDs carry limited risks, but one drawback is missing out on better rates elsewhere while your money is locked up. The absence of a penalty helps alleviate this risk. However, inflation might erode your purchasing power if the interest rate is too low. On the positive side, the bank pays interest regularly, and at the CD's end, they return your initial amount along with earned interest. While CDs are less liquid than other bank investments, a no-penalty CD allows you to avoid early withdrawal charges, making it more flexible. Generally, CDs offer higher returns than savings or money market accounts, and you can usually find them at your bank. Number 7, short-term corporate bond funds. Corporate bonds are debt instruments issued by major corporations to finance their projects. They are generally regarded as secure and pay periodic interest, often quarterly or semi-annually. These bond funds are ideal for investors seeking diverse bonds without analyzing each bond individually. They're particularly beneficial for investors with limited funds who can't purchase individual bonds and appeal to risk-averse individuals due to their nature. A short-term corporate bond fund isn't government insured, which means there's a possibility of it losing value. Nevertheless, bonds generally offer a good level of safety, mainly when you're investing in a diverse range of them. Furthermore, a short-term bond fund minimizes the risk associated with fluctuating interest rates, meaning that the fund's price won't be significantly impacted even if rates go up or down. These bond funds contain corporate bonds from diverse companies across various industries and sizes, providing diversification that shields against the impact of poorly performing bonds on overall returns. These funds pay regular interest, often every month. Moreover, short-term corporate bond funds are highly liquid and can be traded on days when financial markets are open. Furthermore, you can purchase them through almost any online broker that offers ETFs and mutual funds. Number 6, money market accounts. Money market accounts are an alternative kind of bank deposit that typically provides a higher interest rate than regular savings accounts, but usually require a higher minimum investment. They're perfect for those needing quick access to their funds without restrictions. When considering a money market account, ensure you opt for one that is FDIC insured to protect your funds because they offer coverage of up to $250,000 per depositor per bank. Like savings accounts, the primary risk with money market accounts arises over time, as their interest rates often struggle to keep pace with inflation. However, this is a minor concern in the short term. The primary benefit of money market accounts lies in the interest earned, alongside the flexibility of accessing funds promptly when needed. These accounts maintain high liquidity, although federal regulations impose some withdrawal restrictions. Fortunately, opening a money market account is possible at numerous banks and credit unions. Number 5, cash management accounts. A cash management account allows you to invest in various short-term options and operates like an omnibus account. These accounts suit individuals seeking a liquid cash account that offers quick access to their money and potentially provides interest on the assets. Concerning risks, cash management accounts usually invest in secure, low-yield money market funds, posing minimal risk. However, in some cases, robo-advisor accounts might place your funds in FDIC-protected partner banks. In such an instance, ensuring that your deposits don't exceed the FDIC coverage limit is crucial, especially if you're already conducting business with one of these partner banks. What advantages do they offer? These accounts commonly enable investments, check writing, fund transfers, and other typical banking activities, providing substantial flexibility. With high liquidity, they allow withdrawals at any time, surpassing the limitations of traditional savings and money market accounts, which often limit monthly withdrawals. Where can you find them? Cash management accounts are usually available through robo-advisors and online stockbrokers. Number 4, money market mutual funds. Despite their similar names, money market mutual funds and money market accounts differ in risks. However, both serve as suitable short-term investments. A money market mutual fund invests in short-term securities like treasuries, municipal and corporate debt, and bank debt securities. As a mutual fund, it involves an expense ratio, which is a fee paid to the fund company from managed assets. Money market mutual funds are suitable for individuals seeking accessible cash while earning a yield. These funds are generally safe, but they don't carry the same level of security as money market accounts backed by the FDIC. Money market funds can potentially lose value, usually during severe market downturns, although they are generally considered safe. Despite this, they remain among the most conservative investment options, providing significant protection for your money. Investors in money market mutual funds typically earn a yield on their investment with little change in the principal amount. These funds offer reasonable liquidity, enabling easy access to your money. Some may even permit check writing directly from the fund, although there's usually a limit of 6 monthly withdrawals. To acquire money market mutual funds, you can buy them through brokers offering them for sale. Number 3, high-yield savings accounts. A high-yield savings account offered by banks or credit unions provides a solid alternative to storing cash in a checking account, which usually yields minimal interest. These savings accounts pay interest regularly. They're perfect for risk-averse investors, particularly those seeking short-term access to money while avoiding the risk of non-repayment. The Federal Deposit Insurance Corporation insures savings accounts at banks and the National Credit Union Administration at credit unions, ensuring protection against losses. These accounts pose minimal risk in the short term, but investors might find it challenging to keep up with inflation over time. With these accounts, you can earn much higher interest rates than traditional brick-and-mortar banks. Plus, accessing your funds is usually fast, whether by transferring money to your primary bank or using an ATM. What's more, savings accounts offered by online banks are highly liquid, enabling effortless additions to your account and rapid access to your funds. Nonetheless, within these accounts, there is a restriction on free withdrawals or transfers, capped at 6 per statement cycle. It's worth noting that the Federal Reserve allows banks to waive this limitation. Despite this flexibility, keeping a close eye on account maintenance fees and ATM charges to minimize associated expenses effectively remains crucial. Additionally, when exploring high-yield savings accounts, a critical step is comparing different banks to identify those with the most competitive interest rates and straightforward setup procedures. Number 2, short-term U.S. government bond funds. These are similar to corporate bonds, but they're issued by the U.S. federal government and its agencies. These bonds include investments like T-bills, T-bonds, T-notes, and mortgage-backed securities from federal entities such as the Government National Mortgage Association. Short-term government bonds are ideal for cautious investors who prioritize safety. They're considered low risk and are well suited for those looking to build a secure and diverse bond portfolio without analyzing individual bonds. While they lack FDIC backing, their safety relies on the government's commitment to repayment, backed by the full faith and credit of the United States. Additionally, a portfolio composed of short-term bonds helps minimize the impact of fluctuating interest rates, reducing the overall risk associated with rate changes. In addition, U.S. government bond funds offer a reliable interest rate. However, it might be lower than corporate bonds due to their higher level of safety. They're widely traded on exchanges, meaning you can buy or sell them on any market trading day. You can purchase them through various online brokers offering ETFs and mutual funds. Number 1, Treasury Bills. Treasury bills, often called T-bills, are short-term government bonds that mature in less than a year. They're considered among the safest investments due to being backed by the U.S. federal government's AIA credit rating. T-bills offer competitive returns and are tax efficient as the interest earned is exempt from state and local income taxes. When you buy T-bills, you do so at a discount from their face value. For instance, if the face value at maturity is $2,000, you might purchase it for $1,900 However, a key downside is that your money is locked up for several months. If interested, you can acquire T-bills directly from the Treasury Direct website or through brokerage firms like Vanguard or Fidelity. Typically sold in $1,000 increments, current T-bill rates as of November 30th, 2023 are above 5% for durations ranging from 1 to 18 months. When choosing the most suitable short-term investments for your portfolio, assess the potential return on investment, liquidity, and associated fees. Ideally, transaction costs should be low, and you should be able to quickly access your money. You should also consider your goals and risk tolerance before deciding on your short-term investing strategy. Though short-term investments are considered safe options for short-term goals, understand that their safety comes at a cost. You likely will be able to earn less in a short-term investment than you would in a long-term investment. What's more, you'll be limited to certain types of investments. But on the positive side, they're highly liquid, meaning you can easily access your money whenever you need it. Moreover, they tend to carry lower risks than long-term investments, so you may have no consequences. That wraps it up for today. If there's anything I missed, please drop a comment below. I'm looking forward to hearing from you.